What if I told you that fund number 10 on today's list pays you 8.9% annually every single month, while fund number 1 starts at just 1.6% but could make you the richest? One $10,000 investment in the right dividend ETF today could be paying you over $1,295 every single month. So stay until the end. I'll reveal 10 dividend ETFs ranked from lowest to highest yield that could transform you from worrying about money to watching it grow automatically. These battle-tested funds pay real cash while building wealth. I'll show each fund's costs, dividends, growth rates, and what your $10,000 becomes over 1, 10, 20, and 30 years. The lowest yielding funds might make you wealthier in the long term, while the highest yielding fund pays monthly. 2025 is a perfect storm for dividend investors. Interest rates are stabilizing, earnings are recovering, and dividend payments are hitting multi-year highs. But this window won't last. Smart money is moving now, and when others catch on, prices will climb and yields will drop. Think about Netflix stock in 2010 or Amazon in 2015. People who waited for the perfect moment watched incredible opportunities slip away. The same thing happens with dividend investing, except most people don't even know the game exists. Not all dividend ETFs are created equal. The funds on today's list passed 3 non-negotiable tests that separate the champions from the pretenders. First, consistency during chaos. These ETFs didn't just survive the 2020 crash, the 2022 bear market, and every correction in between. They actually strengthened their positions. While other funds cut dividends or suspended payments entirely, these kept delivering cash to investors month after month. Second, they're built for the future, not the past. Each fund adapts to changing markets without losing its core dividend focus. They balance traditional dividend stalwarts with innovative companies that understand modern cash flow generation. Third, they offer real diversification that actually protects your money. We're not talking about 10 funds that all own the same 50 stocks. Each brings something unique to the table, different sectors, different strategies, different risk profiles that work together like a well-orchestrated financial symphony. Now, let's start with the fund that has the lowest yield, but might surprise you with the highest dividend growth rate on this entire list. Fund number 1, NOBL, the ProShares S&P 500. Dividend Aristocrats ETF represents the creme de la creme of dividend investing. And here's why. Starting with the lowest yield might be the smartest move you ever make. NOBL exclusively holds S&P 500 companies that have increased their dividends for at least 25 consecutive years. We're talking about companies like Coca-Cola, McDonald's, and Walmart. Businesses so entrenched and profitable, they've paid growing dividends through multiple recessions, wars, and market crashes. Expense ratio, 0.35%. Dividend yield, 1.6%. 5-year dividend growth rate, 13.4%. These dividend aristocrats often outperform during market uncertainty because investors recognize the value of predictable, growing income streams when everything else feels unstable. A $10,000 investment becomes $11,160 in 1 year, $30,240 in 10 years, $91,440 in 20 years, and $276,480 in 30 years. But wait until you see what fund number 2 can do with an even higher dividend growth rate. Fund number 2, DGRW, the Wisdom Tree U.S. Quality Dividend Growth Fund, solves a problem most investors don't even know they have, choosing between growth and income, and it boasts the highest dividend growth rate on our entire list. This fund targets profitable U.S. companies with strong dividend growth potential, emphasizing metrics like return on equity and earnings stability. Holdings include Microsoft, Apple, and United Health Group, companies that grow their businesses and their dividend payments simultaneously. Expense ratio, 0.28%. Dividend yield, 1.8%. 5-year dividend growth rate, 15.2%. Many quality growth companies are trading at reasonable valuations after recent market volatility, setting up DGRW for both capital appreciation and growing dividend income. Your investment grows to $11,180 in 1 year, $31,580 in 10 years, $99,760 in 20 years, and a stunning $315,000 in 30 years. That's the highest 30-year projection on our entire list. But don't go anywhere, because fund number 6 offers something completely different. Fund number 3, VIG, Vanguard Dividend Appreciation ETF, takes dividend growth seriously, focusing on companies with at least 10 consecutive years of dividend increases. This creates a portfolio of true dividend aristocrats, companies that have proven their ability to grow dividends through multiple economic cycles. Expense ratio, 0.06%. Dividend yield, 1.9%. 5-year dividend growth rate, 10.1%. The ultra-low costs mean more of your money stays invested rather than going to management fees. During uncertain times, investors gravitate toward companies with proven track records of returning increasing amounts of cash to shareholders, exactly what VIG delivers. Your $10,000 becomes $10,940 in 1 year, $27,680 in 10 years, $76,640 in 20 years, and $212,200 in 30 years. Fund number 4, DGRO iShares Core Dividend Growth ETF, focuses on U.S. companies with strong track records of growing their dividend payments over time. This fund screens for companies that have increased dividends for at least 5 consecutive years, creating a portfolio of dividend growers rather than just dividend payers. Holdings span from technology giants like Microsoft to consumer staples like Procter & Gamble. Expense ratio, 0.08%. Dividend yield, 2.1%. 5-year dividend growth rate, 11.3%. DGRO's focus on dividend growth means your income stream increases over time, providing protection against inflation as companies pass rising profits to shareholders through higher dividend payments. Your $10,000 grows to $11,210 in 1 year, $29,140 in 10 years, $84,840 in 20 years, and $247,200 in 30 years. Now we're getting to the funds that offer higher current income. And fund number 5 is where things start getting interesting. Fund number 5, VYM, Vanguard's High Dividend Yield ETF, offers something beautiful in its simplicity. Broad exposure to high-quality, high-yielding US stocks at an incredibly low cost. With over 400 holdings across sectors, VYM focuses on companies that return substantial cash to shareholders. You'll find everything from Johnson & Johnson in healthcare to Home Depot in consumer discretionary. Expense ratio, 0.06%. Dividend yield, 2.9%. 5-year dividend growth rate, 8.4%. The fund's sector allocation perfectly positions it for economic normalization, with strong representation in financials, technology, and consumer staples. Your $10,000 becomes $10,890 in 1 year, $26,830 in 10 years, $72,000 in 20 years, and $193,200 in 30 years. But now, we're entering the territory where dividends start paying you serious income. And fund number 6 is beloved by dividend investors for a reason. Fund number 6, SCHD, the Schwab U.S. Dividend Equity ETF, is quietly building a cult following among dividend investors. And once you see these numbers, you'll understand why. SCHD only includes companies that have consistently increased their dividends for at least 10 consecutive years. But it takes it further by screening for financial strength and quality metrics. You're getting companies like Broadcom, Texas Instruments, and Chevron, firms that don't just pay dividends, they grow them relentlessly. Expense ratio, 0.06%. Dividend yield, 3.4%. 5-year dividend growth rate, 12.8%. SCHD has delivered over 12% annual returns over the past decade. Many of its holdings are positioned to benefit from reshoring manufacturing, infrastructure spending, and the AI boom. Your $10,000 investment in SCHD grows to $11,240 in 1 year, $29,680 in 10 years, $88,100 in 20 years, and $261,400 in 30 years. Fund number 7, HDV iShares Core High Dividend ETF, focuses on high-quality U.S. companies that can sustain above-average dividend yields. Rather than simply chasing the highest yields, HDV screens for financial health and sustainability, creating a portfolio of solid dividend payers without the risks that often accompany ultra-high yields. Energy, healthcare, and telecommunications feature prominently. Expense ratio 0.08%. Dividend yield 3.6%. 5-year dividend growth rate 9.2%. After years of growth stock dominance, dividend-focused value companies may finally have their moment as investors seek reliable income in uncertain times. Your $10,000 grows to $11,360 in 1 year, $28,200 in 10 years, $79,520 in 20 years, and $224,400 in 30 years. Now here's where it gets exciting, because the next fund breaks the 4% yield barrier. Fund number 8, SPYD, the SBDR Portfolio S&P 500 High Dividend ETF. And this is where we start talking about serious current income. SPYD takes the 80 highest yielding stocks from the S&P 500 and weights them equally. This creates a unique portfolio heavy in real estate, utilities, and energy, sectors that traditional market cap weighted funds often underweight. Expense ratio 0.07%. Dividend yield 4.1%. 5-year dividend growth rate 6.7%. Many of its core sectors are positioned for a renaissance as interest rates stabilize and infrastructure spending increases. Plus, equal weighting means you're not overly dependent on any single stock's performance. Your $10,000 becomes $11,410 in 1 year, $28,460 in 10 years, $80,960 in 20 years, and $230,400 in 30 years. But fund number 9 takes us international and pushes the yield even higher. Fund number 9, FDVV, the Fidelity High Dividend ETF. And here's where most American investors make a huge mistake. They ignore international dividend opportunities entirely. This fund focuses on developed international markets where dividend yields often exceed US level. FDVV targets high dividend companies across Europe, Asia, and other developed markets, providing geographic diversification while maintaining focus on sustainable dividend payments. Companies like Nestlé, ASML, and Taiwan Semiconductor represent the global dividend elite. Expense ratio 0.25%, dividend yield 4.2%, 5-year dividend growth rate 7.8%. Currency dynamics and relative valuations make international developed markets particularly attractive, especially as US markets appear increasingly expensive by comparison. Your $10,000 grows to $11,420 in 1 year, $27,480 in 10 years, $75,520 in 20 years, and $207,600 in 30 years. But now, for the moment you've been waiting for, fund number 10 is about to blow your mind. Fund number 10, JEPI, the JP. Morgan Equity Premium Income ETF. And this is the monthly income machine that changes everything. This isn't just the highest yielding fund on our list, it's a complete game changer for anyone who wants monthly paychecks from their investments. JEPI uses a covered call strategy that generates extra income on top of regular dividends. Think of it like renting out your investments for additional cash flow. Expense ratio 0.35%, dividend yield 8.9%. This fund pays monthly, not quarterly, like most others. That means 12 payments per year instead of 4, making it perfect for anyone building immediate passive income. Volatility often increases covered call premiums. And with potential market uncertainty ahead, JEPI could deliver even higher yields while providing downside protection. It's like having a financial shock absorber that pays you for the privilege. Your $10,000 in JEPI becomes $11,890 in 1 year, $25,940 in 10 years, $67,280 in 20 years, and $174,600 in 30 years. But here's what makes JEPI special. While it has the lowest 30-year projection, it provides the highest current income, paying you $890 in dividends in year 1 alone, and those payments come every single month. Now that you know all 10 funds, ranked from lowest to highest yield, let's talk strategy, because combining these funds intelligently is where the real magic happens. You don't need all 10 funds. That would create unnecessary overlap and complexity. For maximum current income, Combine JEPI's monthly payments with SPYD's high yield and SCHD's quality approach. This trio provides regular cash flow while maintaining reasonable diversification. For long-term wealth building, focus on the lower-yielding but faster-growing funds like DGRW, NOBL, and VIG. These funds prioritize dividend growth, meaning your income increases over time, while building wealth through capital appreciation. For balanced exposure, consider VYM as your core holding, with smaller positions in FDVV for international diversification and HDV for value exposure. Let's make this concrete with some real numbers. Imagine investing $1,000 monthly across a diversified selection of these ETFs, with average dividend yields around 4% and historical capital appreciation of 8 to 10% annually. You're looking at total returns in the 12 to 14% range. Over 10 years, that $1,000 monthly investment could grow to over $200,000 to $30,000. But here's where it gets exciting. By year 10, your annual dividend income alone could exceed $9,000. That's real money, enough to cover your car payment, help with your mortgage, or fund that vacation you've been postponing. Look at what happens to a single $10,000 investment over 30 years. The lowest 30-year performer, JEPI, still turns your $10,000 into $174,600.